If you're looking at the market right now and it feels like a uh, coiled spring, just vibrating with tension, you are definitely not alone.
Yeah, it really does feel like that.
We're truly at a critical inflection point in the economy, especially with this holiday-shortened trading week stretching out before us. It's more than just, volatility. It's a palpable tale of two economies unfolding right before our eyes.
It's quite remarkable, isn't it? On one side, you have this incredible, almost detached momentum from the AI-driven tech sector, just powering ahead.
Right.
Yet simultaneously, there are increasingly undeniable signs of strain for the everyday consumer and our industrial core. The market is trying to reconcile these two very different realities.
And that reconciliation, that deep dive into these complex, often contradictory signals, is precisely our mission today.
Mm.
We're going to pull apart the threads influencing stock investing right now, clarifying those opposing viewpoints, from the raw economic data to the Federal Reserve's own internal tug of war.
Yeah, that debate within the Fed is crucial.
Absolutely. Our goal is to equip you with the essential insights, the aha moments, so you can truly understand what's driving the market and why this sharp confrontation of ideas is so important.
Let's begin by pulling back the curtain on this tale of two economies, starting with the undeniably strong side, the AI boom.
Okay.
Last week, we saw some truly stunning evidence from semiconductor giant Micron technology. Their fiscal Q3 revenue wasn't just good, it hit a record $9.30 billion, completely crushing consensus estimates.
Wow.
Their non-GAAP EPS of $1.91 was also well ahead of expectations. It was really quite something.
Their results were impressive, sure, but the real headline, the part that raises some fascinating questions, was their guidance for Q4 revenue. They're projecting an exceptional $10.7 billion.
Incredible number.
And what's driving this? A nearly 50% sequential surge in high bandwidth memory, or HBM revenue. This isn't just a strong quarter. It's a powerful confirmation that the AI investment cycle is a potent secular trend. It feels almost insulated from the broader economy, providing this incredibly strong fundamental underpinning for the tech-heavy NASDAQ.
It's a striking divergence, isn't it? It almost suggests that a significant portion of the market is operating in a kind of parallel universe.
Yeah.
But then we have the other side of that coin, the strained consumer and industrial weakness. Last week also brought General Mills's mixed Q4 report, which was largely overshadowed by a frankly bleak outlook for fiscal 2026.
Bleak really is the word. Their adjusted EPS is projected to fall by a staggering 10% to 15% year over year.
That's a huge drop.
And the reason is quite telling. They're being forced to sacrifice profit margins just to fund promotions and combat declining sales volumes, especially in their North America retail segment.
Which is a classic sign.
It really is. A classic late-cycle economic signal, consumers becoming acutely price-sensitive, actively trading down or simply pulling back on spending.
And this struggle isn't isolated. It's compounded by persistent weakness in manufacturing data we've been seeing for months, which points to a deepening contraction in that sector.
Right.
It makes you wonder, can the sheer force of the AI boom somehow pull the rest of the economy along, or will this broader consumer and industrial weakness eventually begin to infect even the strongest sectors, maybe impacting their demand for AI-driven solutions down the line?
That's the million-dollar question, isn't it?
Yeah.
So as we navigate this tale of two economies, the market is clearly holding its breath. And this week, it all funnels down to a crescendo of economic data designed to give us some answers. The upcoming high-impact labor market data, especially Thursday's Nonfarm Payrolls or NFP report, is set to act as a decisive tiebreaker.
A tiebreaker, yeah, that's a good way to put it.
It will determine which narrative, AI strength or consumer strain, truly dominates market sentiment and, crucially, dictates the Federal Reserve's policy trajectory.
That's right. This week's economic calendar feels less like a series of discrete reports and more like a carefully orchestrated buildup, a true crescendo leading to that June Nonfarm Payrolls climax. Each release will either confirm or powerfully challenge the prevailing narratives we've just laid out.
So let's trace this journey, building day by day. Monday, June 30th, we kick off with the Chicago Purchasing Managers Index, or PMI, at 9.45 a.m. ET.
Okay, first up.
While the consensus is a modest improvement, any reading below 50 still signals deep contraction in manufacturing. It's the first hint this week of how resilient, or not, our industrial sector is truly holding up.
It's the initial pulse check for manufacturing health. A surprisingly weak print here, falling short of even that modest consensus, would certainly reinforce the weak manufacturing narrative and shift all eyes to the national ISM report coming the very next day.
Right. Building on Monday's initial read, Tuesday, July 1st at 10:00 a.m. ET brings us the crucial national-level ISM manufacturing PMI.
The big one for manufacturing.
Again, the consensus is still below 50, indicating contraction. A third consecutive month below that threshold would powerfully signal a deepening industrial downturn. We'll be closely scrutinizing prices paid for any signs of tariff-related inflation and, critically, the employment index as a direct input for our NFP forecasts.
Also on Tuesday at 10:00 a.m. ET, we get the JOLTS job openings for May. While the number has come down from its post-pandemic peaks, this report remains a key measure of labor demand and a favorite of Fed Chair Powell.
He watches it closely.
He certainly does. A steady and significant decline in job openings would be a powerful dovish signal, easing wage growth concerns and strengthening the case for earlier rate cuts. It's a crucial piece of the puzzle for the Fed.
Moving to Wednesday, July 2nd at 8:15 a.m. ET, we get the ADP employment report. Consensus for June is a gain of just 90,000 private sector jobs, which is a significant deceleration.
Quite a slowdown expected there.
While its reliability for predicting the official BLS report on Thursday is debated, its psychological impact on the market is undeniable. A very weak print, say below 50,000, would almost certainly solidify expectations for a soft NFP and could trigger a preemptive market rally, signaling the Fed might have more room to cut.
And then the main event, Thursday, July 3rd at 8:30 a.m. ET, the June Nonfarm Payrolls report. This is the single most important data release of the week, directly influencing the Federal Open Market Committee's urgent debate.
This is it.
This is where those conflicting narratives truly collide.
So let's break this down, because this is where the market's coiled spring either unwinds gracefully or snaps violently. The headline NFP consensus is for a slowdown somewhere around plus 100,000 to plus 129,000 jobs, down from May's plus 139,000.
Okay.
Unemployment is expected to hold steady at 4.2%, and average hourly earnings year over year are forecast to show a slight moderation, between 3.7% and 3.9%. How these numbers land could dramatically reshape our outlook.
Indeed. Let's consider the most likely scenarios and their implications, because this is where the aha moments truly emerge. The Goldilocks scenario, which presents the biggest opportunity for markets.
The dream scenario.
The dream scenario, exactly. That would be a headline NFP in that 100,000 to 150,000 range, with wage growth at or below 3.7%. This is the ideal outcome. A labor market that's cooling but not collapsing, alleviating inflation fears, and providing a clear path for Fed easing, likely a September rate cut. This is absolutely the market's sweet spot, setting the stage for a broad risk-on rally.
But then there's the hard landing scenario, a significant downside risk. What if NFP comes in significantly below 50,000 or even turns negative?
Oof, yeah, that's bad.
That would immediately ignite recession fears, leading to a broad risk-off sell-off in equities across the board, even if it cements expectations for aggressive rate cuts. Because at that point, the market is no longer cheering cuts, it's bracing for economic pain.
And this raises a deeply concerning question. What about the stagflationary scenario? This is arguably the biggest, most damaging risk for the Fed and the market.
The worst case.
Pretty much. Imagine a weak NFP, say below 100,000, combined with a surprise increase in wage growth, perhaps above 4.0%.
Oh boy.
This is the worst of both worlds. It signals a weakening economy coupled with persistent embedded inflation, effectively cornering the Fed and leaving them with no good policy options. It's highly bearish for both stocks and bonds, a true sharp confrontation of ideas that could utterly trap the Fed.
And finally, the hot scenario, though less likely given recent trends. What if NFP comes in above 200,000 with robust wage growth?
Unlikely but possible. That would immediately shatter near-term rate cut hopes, causing a sharp sell-off in bonds as yields spike and a significant correction in rate-sensitive growth stocks, particularly in the tech sector. Puts the Fed right back in tightening mode almost.
Okay, and there's one more piece on Thursday.
Right. Also on Thursday at 10:00 a.m. ET, we'll get the ISM Services PMI. While the NFP is clearly the main event, this report measures the much larger services side of the economy.
Still important.
Absolutely. A strong reading here could potentially offset some NFP gloom, suggesting resilience, while a weak one would only compound recession fears, signaling a broader slowdown beyond manufacturing.
So beyond the official data, corporate earnings are now functioning as crucial real-time economic barometers. They offer direct, unfiltered views from the corporate front lines, either validating or strikingly contradicting prevailing macroeconomic narratives.
So this was perfectly illustrated last week, showcasing our tale of two economies. We discussed Micron Technology's stunning performance, which unequivocally confirmed the AI investment cycle as a potent secular trend. That was a clear signal from the strong economy.
Right, the AI powerhouse. But then just days later, we had General Mills giving us that deeply concerning outlook with their bleak FY26 guidance. That served as a major warning signal for the U.S. consumer, confirming the weak economy side of the story. It's a very real-time demonstration of the bifurcation we're seeing.
It's striking how these individual company reports directly feed into the larger narrative, providing tangible evidence. This week, we have two more key earnings reports to watch closely through this exact lens, offering further clarity on consumer resilience and industrial health.
Okay, who should we be watching?
First up, Constellation Brands, reporting Tuesday, July 1st, after market close. They're expected to report EPS around $3.37 on revenue of about $2.57 billion, which would represent year-over-year declines.
So, declines expected. What's the key focus there?
This report is a critical test of consumer discretionary spending, especially for premium goods. We'll be zeroing in on the divergence between their strong beer segment, like Modelo and Corona, and their struggling wine and spirits.
Oh, okay.
Any downward guidance, similar to what we heard from General Mills, would be a deeply bearish signal for the entire consumer sector, indicating a widespread pullback.
Got it. And the second one?
Then, MSC Industrial Direct, reporting Tuesday, July 1st, before market open. Consensus is for EPS of $1.03, a sharp decline, and revenue around $970 million.
A sharp decline there, too. How does that fit the picture?
Well, if we connect this to the broader economic landscape, MSC Industrial is a leading distributor of maintenance, repair, and operations products, MRO.
Right, so directly tied to manufacturing.
Exactly. That makes it a direct barometer for U.S. manufacturing and industrial sectors. Their guidance will be crucial. It will either confirm or powerfully contradict the ISM PMI data we're getting this week. A significant downward revision to their outlook would be a strong recessionary signal, particularly for the industrials and materials sectors.
Okay, that makes sense. Now let's turn our attention to the Federal Reserve. Their current patient stance might seem unified, but it's actually a fragile equilibrium, born from a public and increasingly visible debate between two distinct camps within the FOMC. Each side is driven by a very different competing fear.
It's a fascinating dynamic within the Fed right now. At the center is Chair Jerome Powell's profound dilemma: the deep uncertainty over the economic impact of recent U.S. tariff policy.
The tariff question.
Yes. He's repeatedly stated the Fed is well-positioned to wait for more conclusive data, essentially signaling a reluctance to act until that clarity emerges. He truly wants to avoid a policy misstep here.
Understandable. So who are the opposing camps?
Well, you have the hawkish cautious camp, vividly exemplified by Atlanta Fed President Raphael Bostic. His primary fear is failing to return inflation sustainably to 2%.
Inflation hawk.
Right. He consistently argues that tariffs represent an upside inflation risk, and businesses are already preparing to pass on those costs. He believes the labor market is strong enough to withstand restrictive policy for longer, even forecasting only one rate cut late in the year.
So watch him for any softening.
Definitely. We'll be listening intently for any softening of this cautious stance in his upcoming speech, as that would be a significant dovish surprise for the market.
And the other side?
On the other side, we have the dovish dual mandate camp, represented by Chicago Fed President Austin Goolsbee. His primary fear is the opposite: keeping policy too restrictive for too long and inadvertently causing an unnecessary recession or a rise in unemployment.
More worried about jobs.
Exactly. He argues that tariff inflation has been muted so far and that the greater risk is now to employment. We should expect him to forcefully reiterate his focus on the dual mandate, highlighting the rising risks to employment and making the case that the risk of waiting too long is increasing.
So how does this internal debate play out in the scheduled events this week? Monday, June 30th, we get speeches by Bostic at 2:00 p.m. ET and Goolsbee at 1:00 p.m. ET.
Back to back.
Yeah. This is a rare opportunity to hear a direct juxtaposition of these opposing viewpoints, live, and gauge the current tension within the Fed.
And then the real headliner. Tuesday, July 1st, Fed Chair Jerome Powell speaks at 9:30 a.m. ET. This is his semi-annual monetary policy report testimony, the most important of the week's Fed events. Every word will be parsed.
Every single word. When Powell speaks, we'll be listening for a few critical signals that could truly move markets. First, how does he define meaningful weakening in the labor market for a rate cut?
That's key. What's the trigger?
Exactly. His answer will essentially set the bar for how the market interprets Thursday's NFP report. Second, we'll need to hear any updated assessment on whether the Fed views the inflationary impact of tariffs as truly transitory versus persistent.
Right. Has their view evolved?
A shift to explicitly calling them a one-time adjustment would be a distinctly dovish signal.
And perhaps most critically, how does he frame the internal FOMC debate? Does he lean more towards Bostic's inflation concerns or Goolsby's employment fears?
Where does he signal the balance lies?
Precisely. His choice of emphasis and subtle language will signal the committee's current policy bias. Any significant deviation from his established wait-and-see message, which he's held firm on, would be a major market-moving event. It's here that the Fed's future direction, and by extension the economy's, will start to coalesce.
Okay, so this confluence of clearly bifurcated economy, a deeply divided Fed, and a week culminating in a single decisive data point has undeniably created that coiled spring effect in the market.
Without a doubt.
It's clear that the market isn't priced for nuance right now. It's positioned for a binary move based on whether the Fed gets a green light to ease or finds itself cornered by that stagflationary trap.
Exactly. The resolution will likely be either a powerful risk-on rally, if this soft landing narrative is validated by the data, or a sharp risk-off move if those stagflationary or hard landing fears take firm hold.
So for the S&P 500 and NASDAQ, what are the index-level implications? In a bullish scenario that Goldilocks NFP, say, 75,000 to 125,000 jobs with wage growth at or below 3.7%.
The sweet spot again?
Yeah, that would solidify a September rate cut.
Mhm.
That sends yields lower, giving a powerful boost to equity valuations. The NASDAQ would likely lead this charge, but the rally would almost certainly broaden out to real estate, utilities, and even some cyclicals.
A broad rally. Conversely, a bearish scenario for both indices would be a stagflationary NFP, for example, just plus 50,000 jobs. But a surprising reacceleration in wage growth to 4.1%.
The trap.
The trap. This is the most damaging outcome. The higher for longer rates would severely compress NASDAQ valuations, and simultaneous recession fears would hammer the broader S&P 500, leading to a highly correlated sell-off in both stocks and bonds. This is the scenario that truly traps the Fed and leaves investors with nowhere to hide.
Grim picture. And how about sector-specific sensitivity this week? For technology, those tailwinds from a dovish NFP, meaning lower yields, are quite strong.
Definitely helps valuations.
But the biggest risk to tech is a hard landing NFP that calls into question the sustainability of all that AI boom capital expenditure. Does the spending continue if the economy really rolls over?
Good question. Consumer staples and discretionary are truly on the front line of consumer health this week. A weak NFP would definitively confirm the General Mills narrative of a strained consumer.
So staples over discretionary.
In a risk-off environment, yes. Defensive consumer staples would likely outperform cyclical consumer discretionary as investors flee to safety.
Industrials and materials, tied to the PMIs.
Highly sensitive to that ISM manufacturing report and, of course, MSC industrial direct earnings. Continued contraction here would weigh heavily, making them particularly vulnerable in any hard landing scenario.
Okay. Finally, financials. They seem caught in the middle.
They find themselves in a bit of a tug of war. A dovish NFP leading to rate cut expectations would steepen the yield curve, which is generally quite positive for bank margins.
Good for banks.
But if that NFP sparks broad recession fears, it immediately raises concerns about loan growth and credit quality. Their direction will depend entirely on which narrative about the economy ultimately prevails. It's a tricky one for them.
So this week is truly critical. That coiled spring dynamic we talked about at the top will almost certainly be resolved by the economic data, especially the NFP report, along with the Fed's reaction.
It really feels like a resolution week.
It will powerfully define the path for our bifurcated economy and, crucially, the Federal Reserve's policy in the months ahead.
As you consider all this information, here's a provocative thought to maybe mull over. What does this tale of two economies truly mean for your long-term investment strategy beyond just this week's data?
Look each other out.
Yeah. Is the AI boom a fundamental, pervasive shift that will ultimately pull the weak economy along with it, creating a new wave of demand and efficiency? Or is it merely a temporary, bright shield that delays a broader economic slowdown, perhaps even creating new imbalances in its wake?
That's a question worth grappling with. For the fastest and most frequent updates, ensuring you always get these crucial insights and a clear perspective on complex market dynamics, make sure you subscribe to The Deep Dive.
Definitely stay tuned.
You won't want to miss our next one.